Hello and welcome to this month's episode of Capital Markets View. Hi, Taryn, how are you?
Well, I'm doing much better now that my parents have decided that they're going to try to come over this summer.
Oh,
So looking
wow.
forward to that. If they can manage it, they've both been vaccinated. So yeah, I haven't seen them in, well, a year and a half, I guess.
And they're ready for hotel quarantine?
We'll see. We'll see what happens to the U.S.
Yeah,
travelers
wow.
coming in.
Good luck. Well, okay, good luck. I hope that let's hope the US is not on that list though. You need that 10-day quarantine. So on Tulip Watch, my tulips have buds on, but they haven't quite flowered, and everybody else's have. So I think I planted them too deeply. So next month I'll tell you if we got any tulips at all.
We'll have to do a picture of them.
Yeah, that can be the end one for next month's slides. Right, so let's dive into what is slide 2, which is the first slide with data on European new issuance leverage finance volumes. Now, when we did our prep call yesterday, I think the word to describe my reaction was gobsmacked, because I mean, it's just like, it's massive. I mean, like, so you've got what? 38 billion of high yield bonds, 36 billion of loans. Wow. Look at Q1 21 compared to, Q1 20, Q1 19, Q1 18. I mean, it's amazing.
Yeah, I mean, I think we just finished the quarterly numbers, and I think everyone was a little surprised by how massive the issuance was in the first quarter. And it was, so in Europe, in the loan market, it was the second largest institutional volume quarter ever, after the global financial crisis. And then it was the third largest total volume ever. So those other two quarters were in 2007. The bond market in Europe as well was the largest ever quarterly supply.
Wow.
Since the bond market's taken off over here. And the US was the largest quarter for loan issuance. So they've had, it's a similar story in the US. So it's
amazing. And I guess as long as governments continue to keep on pumping money into the economy, you're going to continue to get that pushing down of people to lower credit levels in terms of what they're prepared to buy to get yield, because yields are just going down and down and down. It's amazing.
Yeah, exactly. I mean, yeah, it's amazing that we're seeing this much supply, but then there is also so much demand for it at the same time. It's not overwhelming the demand at all. We'll discuss that.
Yeah, and let's go to the next slide 3, about specifically leveraged loan volumes. And again, first quarter this year higher than last year. For me as well, I think what's interesting about this is, the other day I did a presentation to a bank and I was looking at the issuance, and there's quite a number of, over 1 billion deals flying around in January, February, March. Some quite chunky deals out there.
Yeah, I think, the bulk of what we've been seeing is refinancing and recaps. M&A was only about 40% of the total volume in Europe. However, there have been a lot of buyouts, albeit a lot of secondary buyouts. So some of this is sort of recycled paper. Obviously, a lot of opportunistic refinancings, recaps. But I was talking to some of the journalists this morning. The pipeline is really full at the moment, and some of these deals are new buyouts, new public to privates, or corporate transactions. So I think there's been a bit of a lag as well in terms of, we're seeing all the opportunistic financings coming, but some of these LBOs take longer to get through. They take longer to syndicate or to come to market. So the pipeline looks really good going forward, which is just amazing at this point. Maybe there's been a bit of a backlog from last year. The combination of, cheap liquidity, CLO formation. It's almost as if everyone's woken up to this and now the market just seems like it's on fire.
I think it's interesting because in the last half of last year, there were some private equity firms who were telling me they quite specifically stood back from the market because they thought people were paying too much. And this is my bad, actually. I should have done a bit of a league table, but it was interesting watching where private equity firms were in the top 10 and who'd done a lot and who'd backed off. And I wonder if it's people are now coming back into the market, perhaps driven by, as you just said, just such overwhelming demand for paper. And the refi and reset thing, it's in loan world, prices are tumbling so much that people are just doing all that all the time. Okay, let's bob to CLO issuance on slide 4. Again, I mean, just look at it; it's amazing. Q1 this year versus let's talk about Q1 last year, Q1 the year before. I mean, it's super high, and driven by three things. I mean, and there's a lot of this is new issuance, so this isn't reset refi. Wow. Okay.
Yeah, we have a separate chart for that. I mean, I think the other point I wanted to make was also that the structures are trending closer to pre-pandemic era as well. So we're getting, that sort of 2-year non-call period, 4.5 reinvestment period. The recent deals look pretty much on that target. But yeah, driven by pricing, as you said, AAA spreads. Do we have the pricing slide next?
We have the breakdown of what they're doing next, which is slide 5, which is super interesting. Looking at of the first quarter, how much is new issue? This is obviously total volume. How much is reset and how much is refi?
Yeah, and so what's really interesting is that the annual record for refis and resets is 25 billion euros, and that was back in 2017. And we've already had 19.3 billion euros in the first quarter. So in terms of refi reset, we're almost at the record.
Yeah, which, I mean, driven by super low pricing on AAAs, relatively speaking. Deals that would reset normally in the course of business, and for want of a better term, COVID CLOs done at the height of the crisis, which only had a 1-year non-call, quite deliberately, in my opinion, structurally, so they could be reset refis a year later when things got better, which they have. Say again, sorry?
Yeah, and so actually on that point, Permira's deal, the Providis 4.
Yep.
That is the first post-pandemic CLO to reset.
Yeah.
And that's happening this week, or just happened. So the AAA then was 145 basis points, and now it's 82 basis points.
Wow. I mean, not far off of a halving in price. Goodness gracious. Wow. Okay. Which of course has a knock-on effect to loan pricing. Because that immediately feeds into where the arrangers know they can push things out in terms of loan pricing, because of course they can work out where the arbitrage is, which I think in previous videos you've reckoned it needs to be about 2%.
Yes, that's right, and it's still and it is. I think it's slightly higher than that at the moment, but yeah, it is still within that range as of the end of the quarter.
Okie dokie. Let's go on to our next slide, which is the weighted average cost of capital of CLOs versus Term Loan B. So, exactly that what we were just talking about. And, you can see CLOs weighted average cost of capital coming down, loan pricing coming down. I mean, it's a direct relationship. I guess that's no real surprise, which is allowing loan arrangers to be very aggressive with their pricing, and is probably helping private equity firms get confident in what they can do.
Yeah, and we're actually at, like I just said about that previous deal, 82. The average of AAA spreads is 83, and that compares to even before the pandemic. So early 2020, they were at 95 basis points. So we're actually below where we were
pre-pandemic. We're lower than we were pre-pandemic. Whoa. Okay. That just shows you the huge demand. Okay. And then our next slide, slide 7, which is institutional market net supply versus CLO issuance. So the over demand versus oversupply. I mean, and look at that March figure, those March graphs. It's just amazing.
Yeah. Yeah, I mean, it will be interesting to look next month because sometimes there's a bit of a lag in terms of the net supply into the LE index, just because it doesn't go into the index until the deals allocate, whereas we track the data based on the launch date. So there sometimes is a bit of a lag. But at the moment, it just looks like demand, on a rolling 3-month basis, demand has just shot up. So that's the shortage is about 7 billion euros. And actually, the net CLO issuance has been higher than net loan supply every month since June last year. So this story continues to roll on.
Taking this and rhyming it with what you said earlier about how your journalists are seeing good forward pipeline, I mean, I've always predicted, and I think you've joined me in predicting, that potentially the tail end of the year might not be so good because of economic environment, defaults coming out, people doing deals now and not doing it towards the end of the year. Perhaps it's time to revise that prediction. Perhaps a good forward pipeline compared with market sentiment, which is decoupled from general economic sentiment, perhaps, means we might have a reasonable second half of the year.
Yeah. And, I was just talking to Isabel, who's our default restructuring journalist, and, there's not much going on at the moment. Even, some of the situations are just a bit deadlocked that have been rolling on for a while, but there aren't a lot of new situations. There's so much access to liquidity.
Yeah. No, true. Okie dokie. Let's have a look at our next slide, which is loan pricing. So slide A, average B-rated euro-denominated term loan B spreads and yield to maturity. And there you go, And I think your journalists were already writing about 4% yield to maturities and heading below that as an all-in yield. Which is where we're heading again. And spreads, well, I mean, I've been saying for a while, I think spreads are going to, hit 350 not far away now.
Yeah, I mean, there is some more room to compress for the spreads and yields, because we actually aren't yet back to where we were end of Q1 last year. We are lower than we were at the year end, but there is still some room to go lower to reach sort of pre-pandemic levels. We have also seen a lot of repricings in March, about the same level as February. And we'll be looking at that data again to see kind of what's ripe for repricing in terms of outstanding issuance.
Yeah, cool. And let's go to the LE, slide 9. Yeah. So secondary market kind of recovered.
Yeah, so it actually went through the pre-pandemic high from 2020 back in February. There's been a bit of softness in March, so a lot of the new supply coming into the market, investors making room in their portfolios. Some of the pricing on the break hasn't shot up as much. So there's been a bit of softness in March, but we've recovered. This is that V-shaped recovery that everyone was talking about.
What's really interesting about this graph is I see research that comes out every now and then, not from us, from banks, about CLO managers trading and how returns are linked into how active a manager is and all that kind of stuff. And it's really interesting. So I'm sticking my finger at the screen. Kind of October, November last year, a little bit of a dip in the LE. August, September, a little bit of a blip. It'd be really interesting to track CLO managers' secondary purchases versus these small ups and downs in the LE. And I know some of the arranging banks do track them quite closely. It'd be fascinating to do that kind of correlation.
I think also the vaccine news had a positive impact, because that was in November last year, and you can actually see that in the chart. That has really helped boost the market. And I think that's the other part of what's happening, is that in addition to just all the economic stimulus and the monetary stimulus, that there is the vaccine boost, and people think the economy is going to recover because people are getting vaccinated. So that's part of the story as well.
Cool. And slide 10, pro forma debt to EBITDA ratios, slightly up, fundamentally stable as it has been at 5 times for a number of years. You and I talked about other things around this slide. So how Equity levels are now at around 50%, highest they've been for many, many years. And debt to EBITDA, the multiples, the prices that PE is paying for companies, really high at the moment, high multiples. And so it's the whole kind of structuring thing around what's going on.
Yeah, and I guess equity markets valuations are so high as well. So there's competition for assets from the public market. So, private equity is obviously going to be competing for secondary buyouts with the IPO market. So that's going to drive multiples. I think things continue to be aggressive. We're kind of just sliding back in where we were before the pandemic in terms of leverage levels, structures on deals, margin ratchets. There's been some news about, there has been some pushback on margin ratchets. There was this Belgium-based tech group, Team Blue. So they agreed to amend the margin ratchets to make them less aggressive. So investors continue to push back on some things. But I think the feeling generally is that we're just back to where we were in the first quarter of 2020 in terms of supply, demand, and aggressiveness in structures.
And let me just flip to, slide 11 is something that, and actually 11 and 12, I have to give credit to my colleague Paul Waters for putting together a lot of this data, and my colleagues generally in ratings. So this is basically a guide for people as to when we think certain industries are going to recover. And then if I flip to slide 12, this shows the trends in our downgrades. And obviously there were a fair amount as the crisis began to take hold in sort of spring last year. And normalizing is a word that's difficult to use at the moment because we still are in the middle of the pandemic. But in terms of ratings, downgrades versus upgrades, it looks like a more regular picture. Going forward, will there be more waves of downgrades? I think at the moment we're generally predicting that won't happen as the vaccine rolls out. So have we normalized as much as it's possible to say in the circumstances without really being able to predict exactly what's going to happen? Things are looking certainly a lot more even keeled now. And that
we'll take it.
Yeah. Yeah, no, absolutely. Yeah, no, I'm with you on that one. And that brings us to the end. So, Taryn, thank you very much. I would say to all our lovely viewers, tune in next month to see if Taryn's parents' trip is booked and my tulips have blossomed. And I promise a picture if they have. So as ever, any questions, please feel free to phone or email Taryn or me. Thank you very much.